The Federal Reserve is losing tens of billions of dollars every single year. And if you haven't seen it floating around the internet lately, this is the chart of how much money they used to make. And this insane drop off a cliff that looks like a penny stock or a meme coin collapsing is the amount of losses the Federal Reserve has sustained since 2022, which was the last year they actually turned a profit. But wait, you're probably thinking, I thought the Federal Reserve just printed all the money they needed anyway. So what does it mean to have an entity like the Federal Reserve have losses? Are there any real world consequences to this? And is it ever going to turn around? First, let's explain this chart that you're looking at here. You can see after the financial crisis, there was a certain amount of money that the Federal Reserve was consistently making. And in September of 2022, that number turned negative and it has plummeted lower since. The key thing to understand about this chart though, is that everything above zero, meaning profits for the Federal Reserve, are weekly numbers. But everything below zero, in other words, losses, are cumulative numbers. Don't ask me why they made the chart this way. It is absolutely ridiculous to have a prior time frame on the chart show a weekly number and a later time frame on the chart show a cumulative number. In other words, all the losses total up together. But that is what you're looking at here. So we need to change this chart to get a more accurate picture of what is actually going on. And this here is a much more accurate chart that compares apples to apples, and it shows the amount of profit the Federal Reserve generates by year and how in 2023 and in 2024, that was a negative number, in other words, a loss. During 2023, the Federal Reserve lost $114 billion. And during 2024, it improved, but they still lost $77 billion. Now, if we go back to this chart that shows the weekly amount versus the right now cumulative amount, and we change the date so that the chart ends in 2022, we can see more clearly what this chart looked like when it was positive. And what you are looking at and why it was a weekly number before is because of what the Federal Reserve does with its profits, and it pays them back to the US government. But I'm getting ahead of myself here. The first question that we actually needed to answer is, how does the Fed make money in the first place when they're just the money printer? Well, just like any bank, the Fed has income and it has expenses. When you go to your bank, you put money into your bank account, they're going to pay you, hopefully, an interest rate on those deposits, whether it's 0.01%, 2%, 3%, whatever it is, they are paying you. That is a cost for the bank. And in turn, what they have to do is make money somehow with the money that you loaned to them, because that's what a deposit is. It's a loan to the bank. And so they take your money and they loan it out to somebody else for a higher interest rate. Many times they take your dollars and loan them out to the United States government for 4 or 5%, but sometimes they loan them out to individuals for credit card debt or for auto loans or for mortgages. And for the bank to be profitable and to stay in business long term, the amount that it makes from lending out your money needs to be greater than the amount that they pay to you for getting to borrow your money. The Federal Reserve operates in much the same way, and you can see the amount of money that they currently have loaned out by looking at their balance sheet. Yes, this represents assets that they have purchased, but these assets are debt instruments, which means they do get paid back at some point. The assets that they hold on their balance sheet here are US Treasuries and mortgage-backed securities. And you can see that ever since 2022, the amount of assets the Fed has been holding on its balance sheet has been declining, and that is a result of some of that debt getting paid back. Now, the difference with the Federal Reserve is that when they want to buy more assets, they just create money out of thin air, and then they can go buy more debt assets. That also means that when that debt is paid back to the Federal Reserve, if they don't take that money and loan it out again, then that money just ceases to exist. It just evaporates. It's gone. So all else being equal, when the Federal Reserve's balance sheet goes down, that represents money disappearing from the system. Even so, they still have over $6.5 trillion worth of assets on their balance sheet. And that is $6.5 trillion worth of debt assets that are currently paying the Federal Reserve interest. You can see assets like the 10-year US Treasury are currently paying 4.2%. And so any of those bonds that the Federal Reserve owns, they are currently getting paid 4.2% on. Now, it is true that the Federal Reserve does print up money in order to buy up assets, but it is also true that they also operate like a regular bank in that they receive deposits. It's just that they don't receive deposits from people like you and me. they receive deposits from banks. The Federal Reserve is quite literally the bank for banks. And in return for taking those deposits, just like a regular bank, the Federal Reserve does pay interest to banks. This is called the federal funds rate, and it is the amount that banks get paid for holding reserves overnight. So when people talk about the Federal Reserve raising or cutting interest rates, it's specifically the federal funds rate that they are talking about, because that is the one interest rate the Federal Reserve actually controls. And you can see how when the federal funds rate is very high, that would incentivize banks to keep their reserves with the Fed so that they get a really high interest rate risk-free. However, if the federal funds rate is really low, let's say at 0, then those banks need to make a profit on their money. So they're gonna push that capital out into the private market, try and lend it to individuals and businesses so that they can have a positive return on their money. So paying interest to banks is one of the Federal Reserve's costs, but they have other costs as well. And one of the largest examples of government waste and a misallocation of resources, the Federal Reserve employs more than 500 researchers and more than 400 PhD economists. In fact, they are the largest employer of PhD economists there is, to do something that literally a computer program could do, and probably even more effectively. And finally, the Federal Reserve pays dividends to its banks. So we talked about how the Federal Reserve makes income, and that is from all of the interest they're receiving on all of the $6.7 trillion worth of assets that they hold. And we also talked about the Federal Reserve's expenses. They have to pay out interest on reserves to banks. They have to employ a bunch of people that are not really doing anything. And they also have to pay out dividends to their banks. In normal environments, for the Federal Reserve, just like for a regular bank, the income would exceed the expenses. In other words, they would be profitable. This is what we saw from 2011 all the way through 2022. And when the Federal Reserve is profitable, in other words, its income exceeds its expenses, all of that profit goes back to the government. It sends that cash back to the US Treasury at the US government. That is why this chart is called earnings remittances due to the US Treasury. Just to give you an example of the implications of how this works, in an extreme example, let's say that the United States government was able to get its entire national debt into the hands of the Federal Reserve. Right now, the national debt is sitting at a cool $36 trillion. And let's say Congress gave the Federal Reserve a new mandate that said, you must buy up all of the debt from the US Treasury around the world. And the Federal Reserve's balance sheet went from 6 trillion up to 42 trillion because they bought up all US Treasuries. Well, right now, the US government spends $1.2 trillion a year on just the interest on the debt. So that $1.2 trillion would go to the Federal Reserve, and most of it would get sent right back to the government. In other words, if the Fed were to monetize the entire national debt, it would become interest-free for the US government, eliminating almost $1.2 trillion worth of expenses this year. And every year that gets higher and higher and higher. And that would just cease to exist as a line item on the budget for the US government. So if that's how the Federal Reserve's income versus expenses work, and when they run a profit, they send that back to the government, why are they currently losing money? And more importantly, why are they losing so much money? Well, if you take a look at this time frame, which is when their balance sheet exploded from March of 2020 through about January of 2022, that's also the period of time where interest rates were pegged at 0, which means that those trillions and trillions of dollars that the Federal Reserve spent on buying up US Treasuries from the market, they're currently all on their balance sheet, and they're all still paying very, very little interest. And so yes, the Fed still does have $6.7 trillion worth of assets on its balance sheet, but if those assets are paying a total weighted average of 2%, but they're currently paying out 4% on reserves, in addition to all their other expenses, yeah, they're going to be running some heavy losses. And that's part of the reason why this chart that shows their losses becomes cumulative once it goes underneath 0, once it becomes negative, because the Federal Reserve actually keeps track of this number. They send profits to the Treasury, but if they run losses, they're basically printing the difference. In other words, they are currently printing money to pay the banks to keep that money out of circulation, which means that if they do turn a profit again in the future, which they probably will pretty soon, this number will start heading back up again, but they will not send any profits back to the Treasury until they get back to zero. In other words, they're going to pay themselves back for the $77 billion loss in 2024, the $114 billion loss in 2023, and any future losses they incur along the way before they turn profitable again. Now you think, well, they were just printing money to cover their losses before, so why would they need to pay themselves back once they turn profitable? And it's because what I showed you here when we were looking at their balance sheet, that any money paid to the Federal Reserve that is not loaned back out again into the open market is essentially money getting destroyed. It is ceasing to exist. But while they are running losses, they are simultaneously creating new dollars to pay to the banks. And so once they turn a profit again, they have to undo the inflation, pay themselves back for all that money that they printed into existence in order to keep that game going. Once they start turning a profit again, they need to make sure they suck all those dollars out of circulation that they put into circulation, allowing this total $225 billion of cumulative losses to get back up to zero to destroy $225 billion from the system. But the question is, are they actually ever going to turn profitable again? And the answer is almost certainly yes. If we take a look at their balance sheet, we know the Federal Reserve is ending its quantitative tightening. In other words, their balance sheet is going to start moving sideways at some point very soon here. They have indicated that this is going to be happening in many of their recent FOMC meetings. The longer they maintain a balance sheet somewhere in the neighborhood of $6 trillion, the more interest they start to earn on those assets. Because if a 1 year or a 2 year or a 5 year bond gets paid off, they will take that money and reloan it back out again in order to maintain their $6.7 trillion balance sheet. If they're not letting that balance sheet drip down, but they're not increasing it, they're just letting it stay steady, all of the debt on their balance sheet eventually rolls over. And it rolls over at current interest rates, which means all of the bonds that they had that were paying 1 or 2% eventually get replaced with bonds that are paying 4 or 5%. At the same time, if they do move interest rates any lower from here, that means their expenses go down as well. So the longer time goes on, the lower their expenses get and the higher their income gets from their balance sheet, which means that yes, assuming things continue to go the way they're going, they will start turning a profit again. And once they've paid themselves back the current $225 billion of losses, and in the future that will probably be higher, then and only then will they start taking their profits and paying them back to the US government again. And considering that the US government is currently running $2 trillion deficits, any amount of money paid back to the government from the Federal Reserve should help out with this number, lightening the load on either taxes or borrowing or both. At the end of the day, this is just how the system works. Whether you agree with it or not, this is what is happening. We can talk about the ways that it should be, but the more helpful thing to do is talk about the ways to survive and thrive in the way the system really is. And the fact that deficits have continued to get worse for the last 25 years straight, the cost of paying for the national debt has started to go parabolic, and the Federal Reserve has a history of bailing out the US government by buying up a bunch of its debt whenever there's a crisis, means that we are in for a longer period of time with higher prices, higher inflation, higher interest rates, and we should invest accordingly. There will be periods of time where interest rates move down and prices move down, but those are shorter term moves. In the longer term, move higher, and you should probably position your portfolio accordingly. As always, thank you so much for watching. Have a great day.